Welcome to Outside Views. Today we continue our series BRITURN, the Obstacles. And this is chapter 17, Economic and Monetary Policy. As we examine the possibility of the UK joining the European Union again, whenever that is, it's essential to remember that this would not be a simple reversal of Brexit. The UK would need to apply as a new candidate and undergo the rigorous EU accession process, adhering to all the requirements for membership. And today's focus is on chapter 17 of the Acquis Communautaire, that's Economic and Monetary Policy. And before delving into the specifics of economic and monetary policy, it's crucial to understand the fundamental prerequisites for joining the EU. The so-called Copenhagen criteria define the basic conditions that every applicant country must meet before the accession talks can even begin. And these criteria include political stability with democratic governance and human rights protections, a functioning market economy capable of handling the pressures of EU competition, and the ability to adopt and implement the full body of EU law known as the Acquis Communautaire. And this means that joining the EU again is not a negotiation in the way many people understand the term. It is a process of fulfilling strict requirements set by the EU. Rather than a back-and-forth discussion, it's about the UK proving that it can comply with all EU regulations and obligations. And each chapter of negotiations is therefore not about bargaining, but about demonstrating readiness for integration. Economic and monetary policy is one of the most fundamental aspects of EU membership. And this chapter of the Acquis ensures that member states have sound economic policies, coordinate their fiscal strategies, and work towards adopting the euro. It sets strict rules on central bank independence, the prohibition of direct financing of the public sector by central banks, and ensuring that public sector financial institutions do not have privileged access to funding. For the UK, aligning with these policies would mean significant structural adjustments, particularly given the post-Brexit divergence in economic governance and monetary policy. One of the core requirements for any EU applicant is ensuring the full independence of its central bank. In the UK, the Bank of England operates independently from the government, setting monetary policy without political interference in the best case. However, the UK would need to demonstrate continued compliance with EU standards on central bank independence and integrate its monetary policies within the EU's framework of coordination. The European Central Bank, or ECB, plays a crucial role in the EU's monetary system, and while the UK would not be required to join the euro immediately, it would need to commit to working towards eventual euro adoption in the future. The Stability and Growth Pact, or SGP, is another crucial aspect of this chapter. The SGP ensures that member states maintain sound public finances by keeping budget deficits below 3% of GDP and public debt below 60% of GDP. For the UK, this would mean aligning its fiscal policies with EU standards, ensuring transparency in public spending, and submitting to regular EU fiscal oversight. And the debt is 100 and something of the GDP at the moment. While the UK has historically had strong financial management, post-Brexit economies policies have deviated from EU norms with different approaches to public borrowing and investment. Aligning with the SGP would require a commitment to fiscal discipline and adherence to EU budgetary rules. A significant challenge for the UK in this chapter is its relationship with the euro, of course. While the UK previously had an opt-out from joining the euro, any new membership application would not include such exemptions. Like other new member states, the UK would have to commit to adopting the euro once it meets the convergence criteria. And these criteria include stable exchange rates, low inflation, and sustainable public finances. This would mean that the UK would need to participate in the exchange rate mechanism, or ERM2, for at least 2 years before being eligible to adopt the euro. Given the political sensitivity around this issue, this could be a major hurdle for UK policymakers and the public. Another key element of EU economic policy is the coordination of national economies to ensure stability and competitiveness. The European semester is the EU's annual cycle of economic policy coordination, where member states submit budgetary and economic plans for review. If the UK were to join the EU again, it would need to participate in this process, ensuring that its economic policies align with EU-wide objectives. This would mean greater oversight from Brussels on fiscal policies, but also on economic reforms and investment strategies. Financial market integration is another challenge the UK would need to address. As one of the world's largest financial centres, London has operated with a high degree of regulatory autonomy since Brexit. Joining the EU again would mean complying with EU financial regulations and align with frameworks such as the Capital Markets Union and the Banking Union. This would require adjustments to financial regulations, potentially impacting the UK's competitive edge in global finance. Additionally, the UK would need to reintegrate into EU financial supervisory mechanisms, ensuring compliance with rules on market transparency, investor protection, and systemic risk management. State aid control is another aspect of this chapter that the UK would need to address. The EU has strict rules prohibiting government subsidies that distort competition within the internal market. Since Brexit, the UK has developed its own subsidy control regime, which differs from EU state aid rules. Joining the EU again would require the UK to realign its policies, ensuring that government support for businesses does not breach EU competition laws. And this could impact sectors such as energy, manufacturing, and regional development, requiring adjustments to subsidy programs. For businesses and consumers, aligning with EU economic and monetary policy would bring stability and predictability, of course. It would mean access to the EU's internal market without trade barriers, greater investment opportunities, and stronger economic growth. However, it would also require significant changes in policy direction, limiting the UK's ability to pursue independent economic strategies outside EU frameworks. So in conclusion, Chapter 17, Economic and Monetary Policy, represents one of the most challenging areas for the UK in its efforts to join the EU again. Aligning with EU rules would require significant adjustments in fiscal policy, but also in financial regulation, central bank governance, and economic coordination. And while the benefits of reintegration include greater stability and access to EU economic mechanisms, the political and structural challenges are considerable. The UK would need to demonstrate its commitment to economic governance, but also to fiscal discipline and long-term alignment with EU monetary policies. Additionally, the process is not truly a negotiation, as I said in the beginning. Unlike trade deals where compromises are made, the EU accession process requires alignment with pre-existing rules. And I need to emphasize that again, because every applicant must adjust its policies to fit within the EU's framework rather than crafting exceptions. And this means the UK would have to prove its ability to function within EU structures without special treatment. This concludes our discussion on Chapter 17, Economic and Monetary Policy, and in the next episode of the series, we will explore the next challenge in the accession process and examine how the UK might navigate these complexities on the path to a possible EU membership. So thank you for watching Outside Views and see you next time. The next video is already right here in the end screen.